So this webinar is FarmDoc Daily Live, Coronavirus and Ag. My name's Todd Gleason. I'm your moderator for the day. This one on the impact of COVID-19 on agricultural assets and lending markets. Bruce Sherrick, part of the FarmDoc team and the director of the TIAA Center for Farmland Research here on campus, is with us, along with Jackson Takach. He is with Farmer Mac, and we have a poll to get started with. If you could bring that up for me, please, Bruce. Here's a poll that we'd like you to answer now. How much refinancing do you think will be needed this spring on crop farms? Select one of the following: none, not much, some for vulnerable farms, or much more than anticipated. Those of you who were on earlier, you heard me give you a number. Now there are approaching 230 to 40 of you that are online, and that number will continue to build for just a bit as people are joining us. But if you take this poll right now, we'll give you some answers momentarily. And we're asking how much refinancing you think is needed this spring on crop farms. I want to know whether it's none, not much, some for vulnerable farms, and much more than anticipated. About 66% of you have voted. We're getting close to where we're going to go ahead and turn this loose and take a quick look at the answers. And here they are. So most popular, some for vulnerable farms, about 59%. I think from my perspective, that's about where I was at. Much more than anticipated at 31%. I didn't really have a good feeling for that. I think maybe Bruce and Jackson will be able to give us an idea of where they think that might be, that number is, as we go through some of their slide sets. Next question, or next slide, please, in fact. So Jackson Takach is here today. He, I don't know actually where, Jackson, you're at this point in time. Where are you located today?
Right. Well, so thanks for having me, Todd. I'm located just outside Washington, D.C. Farmer Mac is headquartered in Washington, D.C., so I'm coming to you live from my basement in Annandale, Virginia.
Oh, excellent. So why don't you tell me a little bit about yourself and then get started with your slide set, please.
Happy to. So again, Jackson Takach, I'm the chief economist over at Farmer Mac. Now, Farmer Mac, if you're unfamiliar, is a leading secondary market for agricultural real estate mortgage financing, as well as USDA guaranteed lending and rural infrastructure lending. So this is a really interesting topic for us. We have a national footprint. We're not a local lender or even a regional lender. We have loans in all 50 states and credit exposures in all 50 states. So when you talk about something like a pandemic, COVID-19, it's really going to touch every corner of not just the country, but the globe. And so we at Farmer Mac really need to assess every corner of how this pandemic might affect agriculture. And specifically, we're looking at it from not just how it's developing. So of course we care about emergence, but we care about how it's emerging in ag and rural states, right? So one of the things I'm going to talk about is just giving you a little bit more guidance or a little bit more data on how this pandemic is unfolding in ag states and how it's different than urban states. That may also mean that there's a longer event horizon. So we might be in this for a little bit longer than other urban areas where they're peaking this week and maybe even part of next week in terms of hospital usage. Might be a little slower in the rural side, so I can talk about that. But really where I want to get to the heart of this presentation is how is it affecting farmers? And it's not because folks in rural America and on farms are getting sick and are coming down with COVID-19, although there are several cases across the U.S., but it's more of the economic knock-on effect. So what are the derivatives that are affecting the general economy, and how are those flowing back to the farm? So I want to hit those as well. And then what does that mean for lenders? So there's a lot happening in terms of fiscal stimulus and monetary policy. So I can talk a little bit about how that is going to flow through to the banking sector, to the lending sector, and how it flows through to the farmers. And then I'll also talk a little bit about some of the government support and how that looks and how it helps offset some of the lost income from the economic effects. So just to hit the highlights on the emergence, COVID-19 is a very nasty virus. We've seen, in this chart, you kind of break down some of the developed and developing countries by the number of cases per million. I like to think about it that way because, there's more people in the United States than Spain. So even though we have something like 460,000 cases, and Spain has far fewer cases, when you adjust for the number of people in the United States versus Spain, you see a very different picture. So that's what you're looking at here is the emergence of COVID-19 in the case per million. And that gives you a very different picture. We're more like Germany, more like the original state of Hubei province in China, where the virus originated, and less like some of the European advanced economies, and they've had a little bit more COVID-19 cases per million. Now, it looks very different when you break it down in the United States. So it's not like that the 460,000 case number is evenly spread. So what I like to think about, what is the difference between the urban and rural? So this is a nice way to visualize where the rural counties are. So it's a county map colored by the urban-rural continuum code. So the more red, the more urban, the more people per square mile. The more green, the fewer people per square mile. And if you overlay that with where COVID-19 is, where we have seen the case development, it is far more concentrated in the urban areas. So the Pacific Northwest, where we heard a lot about Washington State. New York is really right now the epicenter of COVID-19 in the United States, and Louisiana. So right after Mardi Gras and Fat Tuesday, we saw kind of an explosion of case activity in the Southeast and the Gulf states down there. But largely in most of the Midwest, and when you break this down by counties by urban versus rural, the cases per million in rural America have been very low comparatively, much more like South Korea than, say, Spain or Italy. And in the urban areas where you have cases exceeding sort of that 1,200 range per million, that's where you've seen a lot more activity and a lot more usage of hospital beds, ICUs, ventilators, and some of the scary statistics that are coming out of case development. Now, that's, I think an important thing to talk about in agriculture, the case development. This is really a state by state of the top 10 agricultural states as we've seen the cases develop on a parts per million basis. Big difference between the core ag states and U.S. average. Illinois and Indiana are a little bit higher there just because of Chicago and Indianapolis. But most of the other ag states lag in terms of case development. Great news there is that the direct impacts to farmers, ranchers, and rural residents have been far muted. So less hospitalizations, less usage of ICUs, less cases in general. So direct health impacts are better than in urban areas. But I think we have to be careful about being excited about that. It's definitely one of those cases where the more you see earlier on, the more likely you are to see kind of an early peak and a quicker tail, a quicker convergence on herd immunity. So what you're looking at here is the projections from the University of Washington, and they break it down. You can do it by state. It's a really interesting data set. But on the left, you've got U.S. total, and so they're projecting a peak within the next 5 to 6 days of hospital bed usage. So you get that black line is their expected case, and then you've got a high range and a low range. If you just total up the ag states, of course, you have a far lower peak. You're not going to go quite as high there. You have far fewer people per million in rural areas. But what you also see, and it's harder to see kind of on this chart, but you see a shift of that peak. So in rural areas, because the emergence has been slower, you're expecting more to take longer to get through the population. So you have sort of a wider tail, more into, say, May and June, and a later peak. So it's about a 5-day later peak than the overall U.S. average total. So in states like New York and Louisiana, they're really experiencing the full impact of the health crisis today, and over the next 5 days, it might take a little bit longer to get through direct impacts to the rural communities. Now, what does that mean for agriculture, and how is that flowing back through to farm income statements and balance sheets? Well, I call these knock-on effects or derivatives of COVID-19, and each one of these is really impacting commodity prices and thus income. So it's all about the demand and what is happening to that demand for agricultural goods and services. The first one I think we've heard a lot about is just gasoline. As consumers don't drive, they stay at home. The demand for gasoline goes down, the demand for ethanol goes down, and then the ethanol plants have actually been closing as a result of that decline in demand. So not having that gasoline as a growth driver has directly impacted the ethanol producers, and that has indirectly impacted the price that folks are willing to pay for corn. And that is going to be something that lasts, not just for the next couple of weeks, but even when we start to get back to normal, people will probably not be driving as much as they were prior to the crisis, right? So this is a demand function that's going to continue. We also expected a lot more soybean sales in China phase one. Now, China is doing their best, I think, to buy as much as they can, but they're still coming back from their outbreak earlier this year. So trying to see those massive numbers that China agreed to purchase in ag goods in 2020, I put a question mark there because I just don't know how feasible it will be to get all that 40 billion through China by the end of the year. Their hog markets aren't back, their consumer demand isn't back, and that is causing sort of a slowdown in our expectations for exports. We also have lower global growth overall. It's not just the US and China and the EU that are experiencing disruptions because of COVID-19. It is all across the globe. South America is starting to see their numbers build. You've got all parts of Asia, Europe, Africa, all starting to see increases, and that's going to put a lot of pressure on global GDP, global economic activity. And we rely, our goods and services in agriculture rely on global growth to really drive export demand. So a lower global growth scenario means potential for less exports. That's another drag. And then probably one of the most, right there with gasoline, is the closing of restaurants and schools. Now, this is something that's taken time to really show. The restaurants and schools buy in bulk, and they buy 10 pounds of cheese at a time, not 8 ounces of cheese at a time. So while the grocers are seeing incredible increases in demand, numbers that they've never seen before, a lot of the producers who are feeding restaurants and schools don't know what to do with their 10-pound and 20-pound bags of inputs to different food products. So that has been, I think you've read a lot of stories lately about dumping of milk. This is why, because there's just no scale that you can just immediately take those large bags of cheese and other milk products to retail directly. So that's going to take some time to work out. You also see it in the fresh fruits and vegetables. So all the lettuce that gets created and sold to restaurants and school systems are big buyers of those types of products. There's really not a way for them to produce them and package them for their grocery this quickly. So this is going to take some time, I think, to retool the supply chain to make it work at a grocer level. And then the last two things I'll highlight is sort of knock-on effects. So we've got the dollar skyrocketed in March, come back down to earth a little bit over the last couple of years, but it's all about investors wanting the highest quality of investment. They're going into cash, they're going into hard assets, they're going into U.S. treasuries, and that is all generally denominated in U.S. dollars. So as the dollar gets more expensive, it's more expensive to buy U.S. products, and so you see commodity prices come down and less exports for U.S. ag. So all of these things are swirling around and putting a lot of downward pressure on commodity prices specifically, but also the sales and the number of sales to foreign and local buyers. If we think about direct effects, here's one that we just started to pick up on. In early March, cattle prices plummeted, as did hog prices. So the livestock sector took a big hit, particularly for those of you who are out there raising hogs and cattle. And it was really about the restaurant. I think it started out as a restaurant fear, where restaurants not going to buy steaks, or they're not going to buy the same cuts of meat, not the same quality of meat. But it has started to take a different shape. So what I've done here is map out the daily slaughter of cattle and hogs. So cattle on the left, hogs on the right, for federally inspected slaughterhouses. And we were keeping right along with last year. In fact, hogs were far above last year in terms of number of hogs that were brought to the slaughterhouse on a daily basis. And then in this last week, we started to see some separation where we've fallen off of the prior year. And that really has to do with some plants shutting down. So this is what I mean by direct effects. The packers and the slaughterhouses are seeing workers call in sick. Either they've got the COVID-19 or suspect they might have the COVID-19, or some workers fear that they're being exposed to it. So this is really the first evidence I've seen of sort of the direct impact on the food supply chain. And it's starting with the protein sector. And this would put, I guess, increased pressure on cattle prices and hog prices. If the slaughterhouses and kill plants aren't purchasing those animals, that's going to have knock-on effects to the protein raisers. The other thing I think that's really interesting to keep tabs on and important to keep tabs on is just the importance of off-farm income for financing, but also for healthcare and for those family expenses out there in rural America. Now, we broke this down first by at a county level. What percentage of jobs are in these industries that have been directly affected and directly impacted by COVID-19. So we looked at arts, entertainment, recreation, accommodation, and food services. So these are people going out to restaurants, people working at restaurants, people working in the hotel business. And as you can see, the midsection of the country isn't really that super impacted. The blue indicates a lower share of labor in some of those directly impacted COVID-19 jobs, and we got more of it on the outskirts. So in the coasts and in the southeast, you have a higher population employed by these services. But when you layer in sort of that next layer, so Macy's closed a lot of shops, and so you've seen closures pretty much for all non-essential businesses across the country. So you layer in retail trade, you start to see things get a little bit more orange or more concentrated in at-risk jobs. Even in the Midwest, you've got an increasing exposure to those next level industries like retail. And then the last layer I'll layer in is when you add construction and manufacturing. So this is if projects get delayed, if plants close, either because workers are sick or because they need to shut down, the demand isn't there. That's where you start to see even more color. It starts to spread from coast to coast, and you've got right there in the heart of the Corn Belt a lot of jobs focused on that construction and manufacturing slice. So, this is one of those really important things. There's great support out there in federal programs for unemployment insurance. If you or your family have been affected by a layoff or a temporary furlough, this is something to get on right away. I have friends in Kentucky. I'm from South Central Kentucky originally, and they were furloughed for 2 weeks and were able to get unemployment benefits for those 2 weeks. And that really was a nice stopgap for them to be able to pay the mortgage and feed the family for the 2 weeks that their plant, it was a Toyota plant, had furloughed workers. So this is something increasingly important. And there's programs right now. The government has done a great job, I think, of trying to get those programs started. It's taking time, but they've done a good job trying to buttress what is going to be impacting the Midwest. I think healthcare is another key issue here. So if you're getting healthcare from off-farm sources and that's being disrupted, you've got to figure out a good source for that. If it's COBRA or if it's something else through a local provider. Healthcare is something that you don't want to miss out, considering the impacts of COVID-19 if it starts to spread to a more rural sect. So for lenders, the impacts have been varied. On one hand, you've got lower treasury rates. So it's the U.S. Treasury yield, 10-year Treasury yield, all-time low in mid-March. You never want to see the U.S. Treasury go down rapidly. That usually means there's something bad happening to the economy, but it also lowers the cost of borrowing generally. The flip side is you've got credit spreads. So the anything I mentioned, that flight to quality, anything with any credit risk on it is now suddenly more expensive. So bankers, borrowers out there in residential and commercial and in farming, they may not have experienced that full drop. So it looks like Treasury rates went from 2% to 0.5%, or right around 75 basis points. Everyone, I think, was expecting my farm loan to go down by 150 or 200 basis points. And it doesn't really work that way in a crisis. So we saw those credit spreads widen. Rates are definitely lower for that retail customer, either on the residential side or the agricultural side, but it didn't come down quite as much as you might have expected from the headlines. And the banks are really being asked to do a lot right now. So not only do they have to service the mortgages, so if you have a mortgage payment due on April 1st, even if you don't make that because of some struggles or inability to service the loan, those mortgage servicers have to advance to their investors. So that's going to create a huge demand, a cash crunch on a lot of banks and lenders out there who will have to pay your April 1 due date, even if you don't. They also are asked to be the primary lenders in the SBA loan program. So the CARES Act that was put out in Congress last week laid out a lot of money for small businesses to be able to borrow and buttress their finances for the paycheck protection and be able to keep their payrolls working. This program is really going to be delivered by banks. So the banks have to figure out not only the resources to deliver loans to you and deal with your requests, but they're also being asked to stand up a really intense program to lend out billions of dollars to small businesses. By the way, farmers can access those programs. So that's an important thing to note as well, to look at any sort of offset to your farm businessing. You might be able to access the SBA loan program through your lender as well. And then commercial and industry lending has really ramped up the last couple of years, and we see that in the bank balance sheets. So that's another thing. If the restaurants and retail aren't able to pay their leases and there's kind of a drag on the financial sector there, that could impact lenders and their balance sheets and their credit quality. I mentioned government support programs a couple of times in here. We've seen a really good response. Sometimes it's hard to imagine how quickly and how much information the White House and Congress has to take on to be able to put something together like this. But the CARES Act has set aside about $25 billion already. That's the sort of COVID Act number 3. And there may be more coming. So agriculture's got 25 billion or so, roughly kind of set aside in CCC renewals, as well as 10 billion for sort of direct payments to some of the protein sectors and specialty crop sectors affected. That works out to be about, if you kind of do some math, works out to be about 40% of what income was expected for 2020. We've seen levels like this before in the 2000s, but it's certainly going to be an attempt to offset some of these losses. And then if you look at that as a percentage in the line, as a percentage of assets, it's about a 1.5% return on assets that the government is guaranteeing. So that shows the stability that the U.S. government wants to put into and inject into the farming sector as well as the farm finance sector. So in summary, I've hit on kind of like how the emergence of COVID-19 is impacting rural and what kind of pressures it's putting on income. It's all about commodity prices. There's really not a short-term fix for that. It's going to take some time to get that demand back through. The demand for food at home is probably going to remain strong for some time. Exports may take a little bit of time to renew, as well as restaurant purchases. Off-farm income will be disrupted. So these are all things to consider as you're putting together your requests to your lenders and to the banks out there. The lenders are adjusting, so we see a lot of activity out there. The rates are lower, but they're not quite as low as U.S. Treasuries might have implied. Deals are getting done, and there's some infrastructure disruptions if you think about mortgage offices closing, so the filing offices. So there have been some disruptions, but I tell you, everyone is being really creative and looking for technology to solve some of these physical disruptions. So signing paperwork maybe digitally instead of in person, or filing digitally instead of in person. A lot of that activity is happening, and everyone's being really creative with how to solve those problems. And I think government support is going to continue, not fully replace lost income. That's not what you need. You really just need it to support lost income and try to get us all through to sort of a resolution of the situation we're in today. And with that, I'm going to turn it back over to you, Todd. And thank you for your time. And I'm going to hang out for any questions that you may have.
And actually, if folks have questions, you can write them into the questions section, and we'll get them to them before we close out today. So we'll be around for a while to answer those questions. Why don't you pull up that poll? Speaking of questions, I've got one for you that's related to our next speaker, Bruce Sherrick, who is the director of the Center for Farmland Research here on campus. What are your expectations of farmland prices at the end of 2020? Do you expect significant declines? Small declines, no change in farmland prices, small increases, or significant increases? And while you're doing that, just a reminder that if you want to write a question to us, you can do that over in the gray section. It says questions. Go ahead and tap out a question to us, and we'll be able to get to that as we get to the end of our program this morning. This webinar, of course, comes to you from the FarmDoc team here on the Urbana-Champaign campus of the University of Illinois. I told you that we'd be approaching 300, 350 or so on our webinar this morning. We're right at that 300 mark today, and they voted. I think 60% of them have voted, and here's how they view this set of expectations. I think maybe it would be best to have Bruce Sherrick tell us what he thinks of the answers to these, because this is your area of expertise. Good morning to you, Bruce. Thanks for being with us.
Thanks, Todd. I appreciate the help with our seminars and our webinars here. I think that's probably about what I expected people to say, but if we were honest about it, people have been predicting the decline in farmland for quite a while, and it hasn't really arrived. As we've seen in the first quarter of the transactions during 2020, farmland values have been surprisingly strong, but a bit more variation around the sales prices. And as we reported in our Illinois Society of Professional Farm Managers and Rural Appraisers, we had in 2019 fairly strong markets as well. So we'll keep moving forward here. Okay, and so one of the questions that keeps coming back to us, though, is what's going to be the impact on farmland asset values? Because farmland itself is about a $3 trillion asset on America's balance sheet, and about 85% of that $3 trillion is in farmland. One of the questions is, what happens? Are we going to have a decline in farmland values? We get questions about, does it look like the 80s? Does it not? And I'll just kind of quickly walk through some of this. I know we're going to be pushed on time a little here, but there's an awful lot of uncertainty in the equity markets. Have a slide coming up just to show the remarkable changes that have happened and how much of that has been focused in the last couple of months. And we're beginning to see inquiries from kind of the perimeter. People who are saying it's really complicated to think about my 401k being entirely in equities. What do we do now? What's the impact on the valuation if the cost of capital goes down? Well, of course, that's very supportive of long duration fixed income style assets. But we don't know much about the income side yet. We still have a lot of uncertainty about trade. We have uncertainty about the return of demand. We want to think about those two things in concert. So potentially lower demand going forward, but potentially lower cost of capital as well. And those two will battle it out to determine what the fair price of farmland is. A couple of other items, though, farm policy prospects in an election year. If we were to go back for however long we have had active farm policy, we probably don't find a whole bunch of examples where election year is the right time to make the middle of the country really mad. So I think there's at least some positive prospect for, as Jackson indicated, some additional support, at least for this year's effect on the income side. And then I'm going to switch to a couple graphs that go a little more quickly here. Crop insurance projected prices are pretty well above market now. So people are thinking about kind of their insured value as much as their potential for revenue changes around things that relate on the price side, at least. And we do expect some acreages to move towards soybeans. But crop insurance is still going to behave about like it should. Finally, the consumer-driven issues. We have historically focused on the move toward people understanding the attributes in their food and how their food supply channels are beginning to work. But we've taken roughly 50 or just under 50% of the expenditure on food that we used to spend on restaurants and out to eat and directed that through grocery stores. So it's, as Jackson correctly pointed out, it's hard to move those aggregates quickly. And will consumers go back to their original demand? Difficult to tell. Just very, very quickly on this slide, just to remind us that the crop insurance projected prices are actually at a very low level relative to history, only above 1 year in the last 10 on corn. And we're having kind of indications that the market doesn't expect us to get back above those insured prices by the end of the season. The slide that I do want to use, though, to make some of my point is a little complicated to understand at first. I update this slide every single week, and it just goes back all the way to 2001. So the front kind of left side of the chart is dates from 2001 until last Friday. The front right is just the term to maturity, so 1 month, 3 month, all the way out to 30 years. And the vertical axis is the yield on treasuries. And I put 2 points on there. September 19, 2008, essentially the Lehman crisis and the overnight collapse of the short-term lending markets. And then the period that followed that blue puddle of federal support to create liquidity in the front end, at the short end of the yield curve. And again, there's a lot written on this, so I won't spend time. And then March 15th, when we essentially did the same thing. Not making the case that it's similar to the period of crisis after the housing crisis, just pointing out that the rate of yield on short-term fixed income is down, and that's highly supportive of farmland values as well. The Fed's emergency cuts are really quite rare, and we had 2 of them off cycle, the last 2, in fact, and moving back down to a target rate of 0 is important. The liquidity support that the Fed has promised is fairly unprecedented. I think one of the things that I think is funny is that we've had an unprecedented use of the word unprecedented in this last month. Just so many new things. But I think this idea that we're going to have the ability to support and have liquidity in the markets is not something to take for granted. This is a very important mechanism to help stabilize things. But what does it mean for agriculture? And here's a good way for me to think about it. The solid lines at the top are just the first of the year Treasury yield curves from 1 month to 30 year. And the 3 dotted lines are 3 dates in 2020. And they have increasingly sort of dropped. And one of the ways we think about farmland returns is to think about the annual cash return as being something kind of like a Treasury plus a credit risk number. And so we've been able to use this relationship through time to say, if you just simply capitalize the rent, would it give us a value that comes close to what we actually see in the market about farmland values? And except for the period in the 80s, as shown in the top slide here, and again, we have kind of a lender-based crisis in the 80s, or at least a financing crisis when interest rates were 18% nominally, and now they're down to 1.5% to 3.5%. So we're really in a completely different era. Very low cap rates are still very supportive. And if we look at the last few years in farmland values, and I just pulled 3 states, Illinois, Indiana, and Iowa, given where I happen to be sitting, the case is similar in other parts of the country. California, a bit different, a little more supported by permanent crops, and Southeast a little different as well. But generally, this is a good way of thinking about the relationship. Ag has become an increasingly attractive asset class and increasingly acceptable as well. The scale in the investable space, if you will, is still very, very low. We don't have a lot of ways of making these investments without going through very large, we haven't divided that up and made retail items yet, but those items are growing. And most of you have seen at some point some crowd-funded option or, buy farmland on your phone kind of option. Real quickly, and I know we're running out of time, this is just a slide that if you want to spend time looking in your handout, I think makes a remarkable point. If we take on the left side in green, the largest Dow point gains, and then in the middle panel, largest losses, and then on the right-hand side, pick all of them, but order them by time. What do you see? Well, the top 16 are all in the last couple of months. So I don't think we have investors who have a sense yet of what to make out of the volatility in the equity markets, but increasingly we're seeing that drive people toward the stability that you get from investing in ag. Last couple of slides for me. Farmland, I won't walk through all the numbers on this chart, but if you compare it to other asset classes, actually does perform extremely well. Illinois farmland, or NACREIF, as the 2 examples of our national indexes that we can look at, and then equities in the middle and fixed income at the bottom. Farmland does tend to have the remarkable characteristic of being positively correlated with inflation, negative or zero correlation with equities, and have a fairly low relative risk. So I think that is an important thing to remember. Even if prices go down a bit, and they could, not going to predict directional rates with great certainty. I don't think we'll have a big run up, but I don't think we're going to have a giant decline either. Farmland markets tend to move very slowly. Over the long run, they have performed extremely well. So last things to think about. I think continuity in transactional markets is still really complicated, but as Jackson indicated, our filing centers, our county courthouses, we figured out largely ways to keep things going, but they've slowed down. Number 2, volatility in loan rates is going to remain for quite a while. I don't think we get 1,000 points up, 1,000 points down. A good friend, somebody who actually works at Farmer Mac, put out a poll in jest, will we have 1,000-point increase in the Dow today, 1,000-point decrease, or both? And we can have that on a given day. Potential disruptions in the food chain going forward, and especially over the summer months, I am very concerned about this. If we have 2 or 3 more major kill plants shut down, or we end up with a pathogen in a fresh fruit production system, or whatever, we can really put big kinks in the system, and it kind of changes the section of the grocery store that you can see kind of emptied out. Skipping down, I do believe that one of the positives for agriculture is the fact that people are recognizing that GMOs are very important in medicine, and that we are probably going to normalize a lot of technologies that we didn't understand were really common, and probably help consumers understand better issues around GMOs. The ag sector is continuing to financialize. People recognize that farmland is an incredibly good portfolio asset. So if your investment horizon is long enough, it tends to be a very attractive asset. And finally, this is just not a crisis that originated in agriculture or in the banking system. Unlike 2000, or unlike 2008, or unlike the 80s, this has just got a different wrapper on it. And I don't think in 10 years we're going to look back and say agriculture was the source of any of this. On top of that, agriculture on the animal side in particular has been pretty aware of and comfortable with very complicated pathogen management systems and health management systems in production sectors. So I think we're kind of in pretty good shape for dealing with this going forward. With that, I apologize, we're a bit over our timeline. We always want to thank all of our FarmDoc sponsors shown on the page here. We have had quite a few questions. I think we'll kind of end the formal presentation, and those who would want to stick on, maybe we can treat a few more questions, but Todd, I'll turn it back over to you.
You bet. So we do want to thank our FarmDoc sponsors, and in the mean space, you can go ahead and write those questions out. By accident, I deleted a couple. One of them, I don't know what the question was. If the local lender who was looking for a particular indicator, and my problem was I don't remember what indicator they were looking for, could tap that back out. We'll get that answered as well. Of course, we're sponsored by the Center for Farmland Research. Thank you very much to Bruce Sherrick and company, Compeer Financial, Farm Credit Illinois, the Illinois Corn Growers Association, Growmark, and the Illinois University of Illinois College of Agricultural and Consumer Economics, along with ACE, Agricultural and Consumer Economics, which is the department most of the FarmDoc team, actually all of the FarmDoc team belongs to. So thanks to them. There are some upcoming webinars that we'd like you to know about as well. On Tuesday of next week, Scott Irwin and Jeff Bunting will be here to talk about crop supply logistics. And then on Friday next week, we'll be getting into the 2020 crop that's been planted, that with Emerson Nafziger. So you can join us for those two. Now let's take a couple of quick questions. I don't know, Bruce, whether you've had a chance to look through them at this point to see what you want to answer first. If not,
sure,
I can go ahead and give you some questions.
I'll take a stab at a couple of these. How is this interfering with export markets? Well, we have, and Jackson, feel free to help me complete these questions. We've had some response. China does seem to be picking up purchases in some cases, but I think it's too early to fully know. Once you move a ship, it's hard to get it back on the right channel. I think it's going to take a long time, and I've always said that the half-life of recovery is twice as long as the event when you talk about trade. So if we interrupt things for a year, it'll probably take 2 years to get back to about halfway. Any other comments, Jackson, you see on that?
I think it's so multi-channeled here on the impacts to the foreign that you're exactly right. You can't just flip the switch and have everybody repurchase the rest of their year again. You've got commodity prices, you've got exchange rates, you've got supply side disruptions. So can we even ship things in the same places? So all those things will take a little bit of time to work out.
Another one, what about inflation as we continue to pump out stimulus dollars? What is the impact in the long run? That's going to be debated until we know for sure. I think if it is a direct replacement of things that weren't regenerated in the economy, then it doesn't tend to be quite as inflationary. But if we overdo the equivalent, it's a complicated macro set of linkages, of course. But if we overdo the equivalent of printed money with another stimulus infusion that might be a couple trillion more, I think it's pretty clear that inflation can follow from that. Right sizing this support is going to be an incredibly complex thing to get right. Another question I'll ask you, Jackson, if there have been other liquidity issues, third-party investors, what do you see kind of upstream and downstream in the conduit channels that Farmer Mac participates in?
Sure, and I can talk about that more broadly. So it's not just the securities that we issue. I think it's about government-sponsored enterprise debt in general. So it goes back to that flight to quality. Farm credit system institutions, banks, anybody who's out there issuing debt into the capital markets has just seen the costs go up as well as the availability and investor set kind of go down. So as everyone's tried to switch back into cash, that credit spread has widened. So access to capital markets has been, I think, slower, but it's still there. So if you look at and see what bonds are being issued out there, people are getting deals done. Investors are spending money and trying to keep the flow of capital going through to ag lenders, and FarmAc being one of them. So the capital markets, while they may have gummed up a little bit with some of the higher credit spreads, they're still getting the money through to farmers where they need it.
Jackson, I've got one for you, kind of a two-part, one from me and then one that was just asked online. They want to know what your sense for the volume of direct-to-consumer sales might be. And I was on with the Extension Commercial Ag folks this morning for a Zoom meeting. We were talking about specialty crops, which might be in part in this area. But the problems that that area might have is related to liquidity, simply because, for instance, they're not able to do U-Pick or farmers markets and what issues they will have.
Yeah, that's a fantastic question. And I think it's one of the things we're learning more and more how interconnected everything really is, and where maybe policy hadn't supported a group before. We have to kind of rethink some of the supports out there for all sides and types of agriculture. So yeah, U-Pick, there's a lot in Northern Virginia. There's a lot of sort of consumer-oriented agritourism type places that are just going to have a tough spring and summer. The flip side of that, what I've seen in my area, and I know this is true in other areas as well, they will deliver. So there's opportunities, I think, to pair up with some of the gig economy workers to do delivery. We've gotten stuff from our local CSAs, from other farms just outside of the DC area. And whereas maybe the grocery store is out of ground beef, I can call up a farm not too far away from my neck of the woods and find that they have plenty in their freezers and are willing to bring it to me. So I think it's a challenge to reroute all these things, and we'll have to rethink exactly how direct-to-consumer sales work. But there are opportunities for consumers out there to continue to reach those farms. It just may take a little rerouting and a little bit of time to figure that out.
Hey, Bruce, how have the early 2020 farmland values held up, and is there enough information yet to say anything for certain?
Definitely not enough to say anything for certain. The question specifically may have come in and saying the Great Plains public land auctions have dried up. We have seen movements in different parts of the agricultural space away from auctions toward listings, in some cases back toward auctions where it feels like there is a palpable regional or neighborhood demand. And it is a very thin market. And so the question is correct that thin markets do tend to support transactional prices, at least until the liquidity to buy that dries up. But this is, again, for 25 years now, I have watched people predict that farmland values would plummet because, and then fill in the next proximate answer. And again, we have kind of seen a decline off of the peaks from 4 or 5 years ago, quite a bit in some regions. But the movements are never quite as extreme as just processing recent changes or approximate changes in expected income might suggest. And I think that's because the long-term demand for food thesis is actually pretty strong. If we don't see growth around the world for the next decade, and if emerging economies stay in their current situation, and if China finds other sources, and if we move away from ethanol, and you can put all the things in a row that do significantly reduce the long-term demand for the growth in calories. All those happen at once. It could be a very difficult outcome, but if all of that happens at once, I still don't think agriculture is the most impacted industry. So in a major world crisis, what asset would you rather own does become a supporting kind of influence on all of this. But yeah, I think the relatively strong end of the year and relatively strong first quarter, that could turn around if we really don't see any replacement for ethanol demand, if we really don't see that China can come back into the world, if we really don't see others picking up demand or finding alternative uses, then those will be influences that will continue to weigh on the farmland market and will push downward on the price. But again, for a few years now, we've been saying a 3 or 4% cash yield on farmland is very low. I think right now a lot of people might look at that and say they would be willing to accept a reasonable way of capturing that kind of income going forward with an asset they expect in the long run to have inflation protection and potential for appreciation. Any others? We have others on our FarmDoc team also on the line today. And if anybody wants to pitch in on these answers, others are much better experts on ethanol in particular than I am. And we have Gary, Nick, and Jonathan potentially to also help with those answers.
I sent Scott the two questions about ethanol directly to see whether, and I'm not sure that he's actually online with us, but I think that he may be. I do have another question. Jackson, during your presentation, you talked about the aid that Washington, D.C. Would be able to provide. I think it's $23.5 billion total. They want to know how that compares to the last 2 years of MFP programs. And I'm not sure that the $14 billion isn't just a replenishment of CCC. It's not been clear yet as to where that is, and the $9.5 billion is kind of like a disaster ad hoc, if I recall correctly.
Yeah, that's my understanding as well. So in the past 2 years, it's been about 15 billion. So last year it was 15 billion spread out over 2019, and then there's 5 billion that was dispersed of that. I think right around 15 into 2020, the early part of 2020. So you're exactly right there, Todd. Like the 14 is a replenishment, and I think most people are looking at that as like, well, if it's replenishing the pot to be able to do more funding like MFP. Before, I don't know if we'll call it MFP, that might be called something else, but it is sort of a replenishment. And whereas the 9.5, I just always round up to 10, right? That is more directly aimed at the dairy, at the cattle sector, and at sort of that fresh food market. So everyone who was disrupted by the restaurant and school closings, I think it's really designed to get some measure of that 9.5 that came out. So I think Secretary Purdue was doing an interview yesterday and said they're working on it and trying to figure out what the blend is, what are the packages going to look like, when are they going to be dispersed. They're motivated, and I think are working really hard to come up with something meaningful to the ag community.
Rob Johansson, the chief economist for USDA on this program last week, was talking about this as a replenishment. And I went back and looked, and maybe you can help me out on the fiscal years. It appears to me that this replenishment would be good for this fiscal year, and that we would, if we had another package, that would come out of CCC. It couldn't come until we got to the beginning of the next fiscal year, which is October 1, maybe?
Yeah. Yep. And so I think that's where you've got maybe some holdover of the $10 billion direct that you can find some disbursements today. You've got the $5 billion that came from the last MFP package that went out in March and April. And so there's also, I think I've heard lots of talk about COVID-19 4, which would be, sort of a fourth round. There was some stuff swirling around up in DC earlier this week about what kind of additional packages might be out there. So there is more coming, I think, in terms of government aid and government support to the economy. So we'll see what kind of additional support the USDA is able to take in those new COVID packages.
And I did get a note from Jonathan Coppice on this issue. He says Purdue clarified the other day that the $14 billion does not go into place until later, June, after they report the spending. So they only have maybe $6 billion available out of those funds. So that's some clarification there. Bruce, I bet you've had some time to go through some of these other questions. What do you want to answer?
Sure, and sensitive to time, appreciate all of those who have stuck around. And of course, we've run over, but we're happy to stay on a bit longer for questions for those who are interested and have the time. A couple of others. One, is there a chance we might see negative interest rates, and how would that affect Midwest farmland values? Boy, that's a question. I hope the answer is no, we don't. It's difficult for me to see how the world's kind of numeraire currency can actually end up with a nominal negative interest rate. I understand how it can with in Japan or in a smaller economy that has a lot of their external trade denominated in dollars or in euros or in a currency that does have a linkage that forces their nominal rate below zero. But I can't imagine what would happen if we ended up with literal interest rates negative in the U.S. And would that impact farmland? Yes, it would dramatically impact farmland, but in my opinion, not by nearly as much as it would impact everything else. So again, in a relative sense, in that case, the relative position might be more important than the absolute answer.
I do have a question, some answers from Scott Irwin. He emailed me back about the ethanol issues. Somebody wanted to know about corn demand and ethanol. He says, I've not seen any estimates for corn ethanol grind being down by 1 billion bushels for the 2019-2020 marketing year. The EIA just estimated ethanol down 11% for 2020. On a calendar year basis, corn ethanol grind, writes Irwin, being down about 500 million bushels is a real possibility, but have to remember that about a third of that will come back to corn and soybean as replacements, lost for DDGs, of course, because that would be the co-product. And taking that into account makes it extremely hard to get even a 500 million bushels net cut in ethanol use for the marketing year. So that's an answer to a couple of those questions. Anything else that you want to go through?
We've had a couple in the area of understanding how the Paycheck Protection Program might apply to farmers. Those with employees, of course, would have one fairly direct answer, but I'm not sure, Jackson, if you have clarity around that. I think those eligibility rules are being interpreted constantly. I think the ability to process applications has been complicated, and if they run out of money before they get to your level of application, I don't think it's completely clear yet what will happen. But any other context on that one? I'm not as familiar with that as I probably should be.
I think the Farm Bureau put out a piece earlier this week that kind of clarified it, and it had to do with some of the revenue issues. So if you're above a certain revenue, which a lot of larger farms might be, even if you have under 500 employees, there was some question around eligibility. I think they've cleared that up. So again, I'm kind of pointing to the Farm Bureau to kind of answer that question. But I think, yes, the farmers would be eligible for the PPP program through SBA. Now, you raise a great point, Bruce, about how's it going to stack up in terms of applications and how does the money go out? I think they're really building the airplane in the air on the program. So everyone probably needs to take have a little bit of patience with it as the lending industry figures out exactly how it's all going to flow through to the SBA.
Jackson, another follow-up question for you, and some follow-up again on the ethanol issue from Scott. He says gasoline usage so far down about 46% from early March. And just a reminder that ethanol usage has not gone to 0%, of course, because they're still going ahead and making and using ethanol at that 10% blend rate. For you, Jackson, in the Great Recession of 2008-09, lending to small businesses dried up. Will that happen now?
I think there's a lot of liquidity being kind of pushed through the lending industry. So it's really about the delivery and trying to get as many people through that process as possible. I think there's an appetite to keep people liquid. It's a very different crisis today than it was. It's more like, and the Federal Reserve has a great piece out this morning that looks at this, but the current situation is more like a disaster and less like a financial crisis. And so in that regard, that's where the two differ. And I think there's a tremendous amount of liquidity looking for a home if we can find a good path to get it there. So getting those pipes to work properly, I think, is going to be the key. And also individuals, like I mentioned, my friend in Kentucky who already received unemployment benefits for the 2 weeks he was furloughed. That shows that there's, I think, a considerable amount of effort on the unemployment offices to try to make sure that there's liquidity out there in the personal space to get people and consumers spending, or at least get them buttressed, and so they don't have the lost revenue. So I don't think it's the same as it was in the 2008 financial crisis. That said, it is going to be a challenge to get as much money as the Fed and Congress has allocated out to all the people who need it.
Do you have any other questions you want to answer, Bruce, or that you've picked through that need to be answered still?
I feel like we've really, stepped on the patience of our audience already quite a bit here.
Watching the number of people, so we're still at, we've got a couple hundred still with us.
I can pick off a couple of them really quickly. Sure. Expanding on the details of the relationship between GMOs and COVID-19. The point was most people think of GMOs as a food issue. In fact, most GMOs are used in industrial production and in medicine. So just by a simple count, the fact that we focus on GMOs in agriculture has been something that we've all dealt with on either side of the issue. But people are if we have a solution to COVID-19 that is genomically based or biologically based, that involves gene editing or use of gene altering technologies to identify a vaccine in 3 weeks, I think all of a sudden people might say that's an okay technology. And my point was just the spillover into agriculture would be to dilute at least the concern that people have about some of the production technologies as they're demonstrated to be efficacious or safe in medicine as well. Well, it has to go right for commodity. Go ahead. Sorry.
Well, I was just going to raise the British American Tobacco. So think what you will about tobacco companies, but the parent company of Lucky Strike is attempting to build a vaccine for COVID-19 inside tobacco plants. So I think that's you talk about GMOs and the use of genetically modified in unique ways and other ways. I think this is one where, hey, maybe agriculture overlaps a little bit with pharmacy and at least raising new types of treatments or new types of vaccines. It's a really interesting case to watch.
Absolutely correct. And tobacco is shockingly convenient in certain ways to use as a genetic model for searching for things. Quite ironic to many people as well, I understand.
Yes.
A couple others on what has to go right for commodity prices to rise over the summer. Not sure that anyone can answer that. And I'm not sure if you want to call it right for there to be production disruptions. Nothing like a good drought to increase prices and again, I hate to point that out, but supply shocks tend to be more important for immediate price changes than slow evolving demand, but hopefully we can restore demand in a long term and increase it somehow at the end of this crisis as well.
Yeah, Bruce, on my Commodity Week program I recorded yesterday, one of the brokers was talking about the potential for a drought or needing some kind of disruption, a production disruption, and he couldn't remember the last time that happened. And I was thinking, well, 12 for drought in last year in the middle of the summer because we didn't get things planted, right? So there are lots of unique problems that are related to that. On a related question, somebody wanted to know if we had a fall cash price. The best thing we have comes both from Todd Hubbs and Scott Irwin and Gary Schnitke, and Gary put it in his updated crop budgets, which are on the FarmDoc Daily website right now, on his latest farm management article using 330 cash price for corn. These would be season's average, and in the budgets that is, and 830 for soybeans. So that's a couple of answers there. Anything else before we decide to close this out, Bruce?
Not for me. Thank you very much, Todd. And thanks to all the listeners and our sponsors as well, and especially to Jackson.
Yeah, thank you so much, Jackson Takach from Farmer Mac, for taking the time with us today. We really appreciate you spending a full hour with us, and well, you an hour and a half because we were on a half hour ahead of this. So thanks so much. I know your time is pretty valuable.
It's my pleasure. Thank you guys for having me.
And thank you to all the folks that have been online with us. You've been, of course, listening and watching a FarmDoc Daily Live webinar, Coronavirus and Ag. You may find this online at farmdocdaily.illinois.edu. Just hit the Coronavirus and Ag button there, and you'll find the archive. A quick, easy way is just to hit the YouTube button under the social media area, and you'll find the archive there pretty quickly as well. I'm Illinois Extension's Todd Gleason on behalf of the FarmDoc team. Thank you for being with us today.